Oh my goodness, it is hard to imagine an indicator that led to more losses for beginners than moving average. You see, moving average is one of the easiest to use indicators that gives you amazingly accurate signals and easily shows 90% of the win rate. And therefore, it is an obvious choice for a beginner. And after 5 successful deals, when you already believe that moving average is your best friend, he will break your heart, and it's gonna be broken in 1,000 pieces, and you lose one trade after another, even though you haven't changed your strategy and you're doing everything right. And this continues until you lose your entire deposit.
50 times?
More.
100 times?
More.
200 times?
More.
500 times?
Probably.
And yes, of course, you probably already understood that it happened to me as well. And only a couple of years later, I realized how to actually use this indicator and why all of those videos that I watched while studying, they did not work for me. And in this video, I have gathered all my experience to save you years of life and a lot of money. So watch carefully, and in this video, you will find out what is moving average, what type of moving average exists, and why are they needed, how to set up this indicator, and I will, just listen carefully, share 4 strategies at once today. And also we are changing up a tradition a little bit, because today we will have back testing on 100 transactions. So in short, this is the most detailed video on moving average indicator for binary options. So now let's get started. And we're going to talk about theory first. There won't be much of it, but this part of the video cannot be skipped at all, otherwise you may not understand the idea of the strategy itself and the subtleties of work further. Okay, so what is moving average? Basically, it's quite simple. So moving average, it's a technical indicator that gives us the ability to see the average value of the price for the specific time period that we choose. So if we look at the chart, you can see that this is simply a line that smooths the little bumps and noises on the chart. To understand this indicator, let's simply look how the formula works, and it's really simple. So right here you can see the blue line. There's a simple moving average with period of 5. What does it mean? For this indicator to know on what level the price is supposed to be, the line is supposed to be, it basically takes the price of the closing price of last 5 candlesticks, and for example right here we have 133,700, 08, 12 and 16 for the last candlestick. Then the indicator basically combines all of them, and we have 6.6853, and then indicator simply divides all of it by 5, finding the average price. Right, so this is like a basic formula for you to find the average value, the average price in our case. And we have 1.3370708, sorry. And at this moment you can see that moving average is like right at this level. And if we change the period not by 5, but let's say 20, we will see that the line is different, of course. And that's because our indicator takes not only the last 5 candlesticks that we just looked at, it's gonna be, oh my god, it's gonna be a lot. Why did I choose 20? It's gonna be 20. It's gonna take all of this 20 candlesticks, combine all of the prices, then divide it by 20, and then of course we will get the average value, average price, and in that case it's gonna be this one. So you can see it. Okay, let's delete everything from a Z chart, and let's look what different period of moving average give us. We're gonna take this part of the chart, and right now we have the period of 20, which gives us the short-term trend for the last 20 candlesticks. And if we have 1 minute time frame, this is the average for 20 minutes. And if we change it for 50, that is going to be medium-term trend. And the line becomes like smoother, and it's the average point for 50 candlesticks or 50 minutes, as you understand. And what do we see here? The price moves further away from the average point, from the blue line, and it shows us the trend direction a bit more. And for us to see the long-term trend, we use 150. You can use 200. A lot of traders use 200. I did as well, but I use 150 more often because almost all of my strategies work better with 150 period. And of course, this is 150 minutes, 150 candlesticks. And what do we see on the chart? And we will see what it gives us. So in this case, for example, we see that the price is in a downtrend and the price is below the average all the time, right? For the last 150 candlesticks, and this is the consistent downtrend. What does it give us? That means that in this place it is beneficial for us to open deals for the downtrend, for us not to work against the trend. So with moving average, we can see the direction of the trend. We can see the reversal of the trend. For example, right here, we see that the price was an uptrend. It was above than the average point. Then it broke through the average point and the price started moving down. In this case, we just talked about how simple moving average works, right? Everything was quite easy, I hope. It's just the average point of the price. Let's change it back to the period of 50. And now on the chart, we only have simple moving average with the period of 50 with the blue line. Besides simple moving average, we also have a lot of different types of moving averages. But in reality, I actually use only 3 of them. So today I'm going to talk about 3 of them. So this is additionally exponential moving average, and it is moving average weighted. So let's talk about what do they give us, and let's get rid of the weighted moving average, the green one, Homeo, and we have simple moving average and exponential moving average on the chart now. As you can see, the exponential moving average, it is much closer to the price, and that basically shows us the price precisely, more precisely. Why does it happen? Because the exponential moving average, if we take 50 candlesticks, the same as for simple moving average, it's going to count not only the average price point, but average price point prioritizing the data for the new data, basically. So for example, this is 50 candlesticks, and the data from the beginning is going to be less important than the data from the end of the period. So that gives us a bit more precise knowledge and a bit more sensitive indicator. And when we want to analyze volatility, almost always you need to use exponential moving average. And of course, let's talk about the weighted moving average, and it's going to be even closer to the price because it uses the same system but gives even more priority to the last data. And the only difference here is that you need to choose different markets for them because you just need to see more about the last data on some markets and have more sensitive indicators. In the end, the main task that all types of moving averages solve is to determine the direction of the trend, which is exactly what we use in trading strategies now. And now let's look at the main ways of using this indicator, and we will start with the most popular strategy, moving average crossover. And even when I started trading, I used to use this strategy a lot. So, moving average crossover is actually quite a simple strategy. We just need to use 2 simple moving averages, and we have them on the chart. The blue one is going to be the simple moving average with the period of 30, and it shows us our mid-term trend. And the fast moving average is the short-term trend. It's going to be the yellow line. And the strategy is simple as hell, as I told you. When a fast moving average crosses the mid-term moving average from the bottom up, we open the deals for an uptrend. When it's vice versa, it's going to be a deal for a downtrend. That's it. That's the whole strategy. And right here on the chart, we have 4 crossovers here, 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 and right here. And let's talk about how would we work with this. In the first case, we have a yellow line crossing the blue one from the bottom up, and we open the deal for an uptrend, and of course it's going to be closed in black. And usually the strategies would be used with 3-minute expiration, so I'm going to be thinking about that as well. Right here, this is going to be the deal for the downtrend, and right here we're opening the deal for the downtrend, and of course it's going to be closed in black as well. Next one, here we see that the yellow one crosses the blue one from the bottom up. Again, same story, it's going to be closed in black. And the last one is going to be right here from the top to bottom, and this one is going to be for the downtrend. It's also going to be closed in black right here. And as you can see, this is 100% win rate, but there is some catch here. What you just saw, this is an example of crossover moving average being perfect for the chart. But let's look at this chart. And here we see 1, 2, 3, 4, 5, and even 6 crossovers at the same time on the chart. So let's analyze them. Right here, we see that here we would be opening the deal for an uptrend. And of course, this deal obviously would be closed in red, and we would lose money. Here, we would be opening the deal for the downtrend, right? Somewhere along the line of this point, and this deal is also going to be closed in black. And I'm going to be just putting all the deals with the little emojis, so I don't talk too much about it, because I think it's quite logical here. All right, so in reality, we would lose all of the 4 places. We have 6 crossovers, and in 5 of them, sorry, not 4, 5 of them, we would lose money. And you would think that maybe this currency pair is not the best, but look at the rest of the chart. This is our 4 deals that we had just a second ago. We talked about just a second ago, but a couple of hours before we had that situation. So a lot of videos with strategies, you would see this situation where the chart would react to the indicator. But in reality, the win rate of this strategy is not really high. And this is the reason why I burnt when I used this strategy, and I lost a lot of money using this strategy because I didn't really understand what was going on, because I was still winning some deals, right? And that meant to me that the strategy was a-okay. So now let me show you how I use this strategy now to avoid these false signals. But before that, I would like to remind you about my second project, which can be extremely useful for beginners. For quite a long time, we have been developing our Academy for traders, which you can join completely for free. And at the Academy, you will receive a ready-made course with 9 lessons and, of course, support from me and a supervisor during the course of training. To join the Academy, you just need to simply text me on my Telegram, link to which is going to be, as always, in the description box down below. But in the meanwhile, let's continue. As you know, I am price action trader, and first of all, I always look at price action, how price behaves right now. So let's look at this example. Here we have an obvious downtrend, right? The price moves along the line of the trend line, not breaking through it and moving up, right? Going still back down. And right here, the price broke through the trend line because there is no bouncing back down and the price is moving up. That means that we are expecting a potential breakout and the price will go up. We look at the moving average indicator. We see moving average crossover happening. And additionally, we have a green engulfing momentum candlestick that absorbs the red candlestick before it. So that means not only we have crossover moving average, we have actually 3 confirmations. And in this case, we can actually open our deal for 3 minutes on an uptrend. And as you can see, the deal would be closed in black, of course. So basically, this is the picture of a really good deals. And this is better to open deals like that instead of opening after every single crossover moving average situations, because that will give you a lot of false signals. That's why you need additional confirmation. Let's take another example, and right here we have a chart, and first thing that we see, we take key levels. So we don't have like a specific trend line. We're gonna mark support and resistance levels. So this is the resistance level, and the support level is gonna be somewhere around here. So, and now let's look at the chart. When the price went to those levels, there was a rebound. Price was bouncing back or bouncing down again. And in this case, what do we have? We see that the moving average gives us the signal to enter a deal for the downtrend. But we see that this is the key level of support. We are not expecting that the price is going to go down, right? We are looking at what's happening after that. So what can tell us about a possible price reversal? We see the dodgy candlestick with like a small body and really long shadows up and down. And it shows us that in the market there is indecision and a big pressure from buyers and sellers. And this candlestick doesn't really give us a lot, but the candlestick after it will show us what's going to happen. If either the buyers will be stronger and the price will go up, or the sellers are gonna be stronger and the price is gonna go down and the level is gonna be broken through. And we can see that we have a gigantic red candlestick, and it not just like covers the first candlestick before it, but all of the candlesticks before it. This is three-line strike, when the candlestick absorbs three candlesticks before it of a different color. And this is a strong indicator that we can open the deal for a downtrend. Additionally, we see that the level is broken through, and of course that means that the price is going to go down. And additional one is moving average here. So in this place, we are opening the deal for the downtrend for 3 minutes. Let's see what's gonna happen there. And oh goodness gracious, it went down. Who's surprised? No one is surprised, and this deal is gonna be closed in black as well. All right, let's get to Quotex and let's try to find this deal on real market in real life time and open a Z trading deal using this strategy. Expiration time 3 minutes. Amount of money that I use is $100, around 2% of my balance. And the first things first is we adding the moving average. First one is gonna be the period of 15, and the Z color is gonna be red, just like in the example. And the second moving average is gonna be the blue one, and the time period is gonna be 30. Okay, so we have them on the chart. That's great. And now I'm gonna find a suitable currency pair to enter a deal. All right, guys, so we're entering our first deal for 3 minutes right here. I'm also expecting maybe there's going to be a good situation on the other currency pair, but this one is the best one, basically. Sorry. So let's look. The price is going to downtrend, and it's following the trend line, the blue line that I put on the chart, and price was moving according to that trend line. And right here there was the crossover of moving average. The price went through the trend line, making a breakout. And why I didn't enter a trade right here, because we have another level here, and for us to be sure and make sure for the deal to be beneficial, we need to wait for this level to be broken as well. So here we have momentum, green candlestick breaking through that level, and we are expecting the price to grow, and I'm expecting the growth to be like around this level as well. So let's see what's going to happen here. Finally. Okay, so it closed beautifully, the price went up, and we waited for all three confirmations, and this is an amazing trading deal. Now let's get to the next strategy. Next strategy implies the use of moving average as a sort of key level, just like the support and resistance levels and the trend line. So let's look at the example. On the chart, we already have simple moving average with the period of 20, and we see that the price actually reacts to our key level of our moving average, and every time touching the level, it bounces back up. Similar to the trend line. So if we add a trend line here, it's going to be similar situation. And of course, there are some exceptions. There are acceptable errors. The price goes outside of the level. That's normal. Again, exceptionable errors. And of course, the logic here is quite simple. We are working with moving average just like we work with any other key level. And I'm going to be honest with you, I personally don't use this strategy. I use it quite rarely in like some specific cases, because this strategy will work until it's stops. Let me explain what happens. So you see that the price was respecting this level, but then just simply stop, and there is a new pattern of the price. So yes, this strategy might be useful, and I will tell you about how many traders work with it, but again, I personally do not use it. So what do we need to do first? First things first, we find a chart that moves respectfully along the simple moving average line. In this case, it's the downtrend. The price moves along the line, right? And it doesn't break through. And we need additional confirmation. Of course, this is stochastic indicator in this case. And you know stochastic, what it is, how it works. If you don't, I have a special lesson for that in my course. But in short, we look at the price, and if it goes to the level of overbought, of oversold area, and if it's in overbought area, this means that basically this is the signal for the downtrend if the blue line crosses the red one. So in this example, we see that this actually happened, the stochastic crossover, and the price goes down. And next one, almost same example here, the price also went down, and here same situation, a bit more complicated, but still the same. And right now we are in the situation where the price went outside of the level of simple moving average. We have two cases. What's going to happen? Either the price is going to ignore simple moving average and go up, doing sort of a breakout, or it will go back down again. In this moment, stochastic is in the level of overbought, and we need to see what's going to happen next. And the next candlestick actually shows us the signal for entering a deal. Why? Because stochastic shows us the crossover, right? And simple moving average goes through, oh, not simple moving average, the price goes back through the simple moving average. And additionally, this is the red golfing candlestick that absorbs the previous green candlesticks. And in this case, we can finally open the deal for an downtrend, and we are opening it for 3 minutes, and let's look at the results. The price is going down, and of course the deal is going to be closed in black. Good job, right? But what is the trick here? The deals like that, you cannot find them a lot throughout the day, when it's perfectly fine, when the price is going along the line of moving average, and when stochastic shows good signals. You won't find a lot of charts like that. And of course, you will have a lot of open currency pairs, and when you're looking through them, you will lose the ability to find the one. It's really stressful. That's why I will show you how I use it in real life. All right, right here we have an uptrend, really slow, really nice and smooth uptrend, and the price was moving respectively on the line of moving average. We don't have like big spikes, nothing like that, but the growth is quite stable. And right now we are in this point, and what do we have here? We see that the price went to the level of the simple moving average, the key level, and we have the Medusa candlestick. Medusa candlestick is a candlestick without a shadow on the bottom or on the top, because it was just growing. And this is a really good signal for us that the price is gonna go go up continuously. And we look at the stochastic and we have a crossover here, but it didn't happen in the over sold area. And a lot of traders would say, like, we can only open deals only when the crossover with stochastic happens lower the level of 20. And I would say yes and no, because specifically with this strategy, if we have confirmation from candlesticks, if we see that the price reacts to simple moving average, I personally do not wait for stochastic to be crossovered in some specific area. In this case, I'm going to open the deal if I see this crossover lower than the level of 50. So in this case, it happened right here. You can see it was around 36, right? This is enough, and it's a good signal for me, again, my humble opinion. And I almost always enter into deals like that, not waiting for perfect stochastic signals. And as you can see, the deal is going to be closed in black, of course, and the price continues to grow. Alrighty, now we're going to try to find a deal and open it in real market, on real market, in real lifetime. First things first, we're adding SMA with the period of 20, adding stochastic indicator, and we need to find the chart that's going to react well. So for example, this one is reacting to moving average, but right now it doesn't anymore. So right now we need to find those charts first. Alright guys, so right here we have GBP AUD currency pair, and what do we see here? The price is actually reacting quite well to our moving average, and the signal that we had before, it kind of worked and the price got back to our level, and we already have the signal from stochastic, but I still do not like the candlestick formation right now. I want to get a candlestick confirmation, and if this one will get us a hammer candlestick, maybe this is going to be our deal for this strategy. Okay, so we're opening the deal. It unfortunately opened a bit later, but the logic here is understandable. As you can tell, we see the moving average, we see the jump, the rebounds, and we had a great Randall candlestick. Great Randall. Oh my god, a great green candlestick. And I was kind of confused about the dragon candlestick that we had before, but it is now really good place, and now we are expecting our deal to close in black. All right, so this deal is closed in black as well, and the logic is really understandable for you here. And the jump of the 20 EMA and the signal from stochastic. Also on my channel there is a detailed analysis of the triple EMA strategy. This strategy is a little more complicated, but the results are extremely good. So let's briefly analyze it. As you can understand from the name, we're gonna use 3 exponential moving averages, and I already have them on my chart. And with the indicators, first one, this is period of 15. It's gonna be a green color for me, and it shows us a short-term trend. Second one is the 30 period. It's mid-term trend, and the long-term trend is gonna be with the period of 60, and it's a red color. So this chart may be in 3 different phases. Right now we're looking at the downtrend, and when we are in a downtrend, exponential moving average basically looks like this. All the lines are separated, they go down, and it's first like red one, slow one, then it's the yellow one, the middle one, and the fast one is going to be on like below everyone, the green one. And then there is a phase of indecision, for example, there is the change of the trend or no trend on the market in general. Lines are intertwining and we don't use those strategies. And there is an uptrend, it's the last one, the third one, and again same thing but vice versa, red one, yellow one, red one, right? And of course, what else do we need in this strategy? We need the indicator stochastic. Of course, we talked about them, and the minimal knowledge of patterns of the candlesticks. With the example of this uptrend, let's look at how we are going to open the deals for an uptrend. Of course, we are waiting for the right formation, so big green candlestick, an uptrend that we see on the chart, all the lines are separated, it's green, yellow, red candles, line, sorry. Then we are waiting for the price to touch the first exponential moving average, the green color in this case. Then we are looking, let's get closer, when the price is bouncing off the exponential moving average, and additionally we need to see the confirmation from stochastic. So in this case, just like in the last one, I am not waiting for the perfect full crossover of the stochastic. We are okay with any crossover below 50 in this strategy, right? And ideally we also need the thick momentum candlestick that covers the previous one. This one is not the strongest, but this is an okay signal for us, and it would be closed in black, as you can see with the candlesticks after. And we also have a couple more examples on this chart. So right here the price went to the level of the green line of EMA, and we have the signal from stochastic, and additionally we have a good candlestick, and it would be closed in black, as you can see, right? And that happens again. Any strategy with indicators means that there is going to be a loss, and it's inevitable. It's just really important for you to have a good strategy in general. So next example, the price was going down and went to the yellow EMA line, right? And you see that it basically gave us the signal. I mean, stochastic gave us a signal as well. We have the green candlestick going outside of EMA. We opened the deal, 3 candlesticks, and the third one is going to be closed in black. Again, we get the money. Next example is right here. So it touched the green line, it went outside of it, and it goes outside of EMA line, and we see the stochastic signal as well. Open the deal for an uptrend, closed in black, good job. And one more example, I would say, it's important at what point we stop going into deals. So for example, here the price went down through the green one and the yellow one, and the green line went down close to the yellow one, and this is the moment when we stop. When they crossed, we stop trading right here because the formation is broken. We are choosing the new chart. And with the downtrend, the situation is quite similar actually. So we find the trend, we find our lines are separated, red, yellow, green. We are waiting for the price to go to the level between the green one and the red one. It doesn't matter if it crosses the yellow one or just the green one, doesn't matter. The really important point is that it doesn't touch the red level. If it does, we are not entering any deals and just waiting for the next formation. So in this case, you see that the price went through the green level, but I wouldn't open a deal here because it was not really well. The next big green candle went through the level really confidently, and additionally we have the stochastic confirmation, and then the price goes out of the green line, and of course the deal would be closed in black. Next example, we have, this is a good example of the price touching the red line, and in this case we see the reversal. But if you look closer, first of all, usually it's a signal for us that the trend is going to be reversed, but this deal specifically would be still closed in red because we would open it right here and it would be closed somewhere right here, so we would lose our money in any case. So if you see it touches the red line, do not work with it, do not touch it, never, just never. And I'm not gonna go into like big details speaking about this strategy because we have a specific video for this topic, a separate video. We have it on our channel and the link to this video is gonna be in the description box down below. As you can tell from this video and of course many other videos on my channel, I always look for additional confirmation before I enter into a trade. And my favorite confirmation indicator is just exponential moving average with a period of 150, as it helps us to determine the direction of the long-term trend. But now let's take the MACD indicator, for example, and conduct a back testing on 100 transactions. Okay, so getting back to the chart, we're adding the MACD indicator. I think most of you already know how to work with this indicator, but I will tell you again a little bit. When we see the crossover of the blue line and red line going from the bottom up and it happens lower than the 0 level under the histogram, this is the signal for us to enter the deal for an uptrend. Like here, and also you can see it here as well, and so on and so forth. And for the downtrend, it's vice versa. The blue line crosses the red line from the up to bottom, and it happens under the histogram. So let me tell you and show you, because I never showed how I do back testing in my videos. So we open the chart and the last price still moving, and we are basically marking our points of the entry points. And right here, this is the first example, 3-minute expiration time. This would be the deal that we would win. I just mark it in any case just so it can be easier for me to see. So what do I do with the table? I make 4 columns. You can see them on the screen right now, and payout for me usually is 80% because I never take a payout lower than 70%, and more often it's like from 75 to 90%, and that's why it's usually like the average 80. The amount of money that I use is $100, around 2% of the deal, and 2 cases that we can get. So we can get $80 if we win. If we lose, it's minus $100, and so on and so forth. So in this case, we won our first deal, and of course I put $80 supposedly. And this way I'm gonna do 100 deals, and of course I'm not gonna show it like in real time, but I'm gonna do 100 deals, put it in the table, and then we will talk about the results. Alright, I am finished with back testing for MACD strategy, and this is all the deals that I've done, and at the end I have $4,900, and this is the stats at the end: 100 deals, 55 wins and 45 losses, and basically you can see all the stats here. So now we are going to copy this table and put it right here, and this one is going to be MACD plus EMA 150. So all right, let's clean the results here, we don't need them, and let's get back to our chart. Of course I have already added 150 moving average. Let's change the color here, it's going to be yellow. All right, We're gonna do basically the same thing, but with additional rule. We're opening only deals for an uptrend if the price is higher than moving average, and deals for the downtrend if the price is below basically the moving average. Same currency pair, let's look at it. Oh, finally, goodness gracious, I am done. I'm done with the backtesting of MACD plus EMA. So there is all of our deals. And by the way, look at this point, I marked it on this 37th deal. I marked it specifically because we did the same amount of deals that we had on the previous one, right? And you can see that this strategy gave us less signals, and that's why in reality you will spend much more time trying to find those deals. But this strategy gave us a good result, positive result. Less deals, but the win rate is higher. Let's get back to stats and let's look at what we ended up with. And we ended up with the balance of $5,980. So if here the profit was minus 100, here it's the profit of $980, and the returns, it's like 1960, and it was minus 2%. And you see the wins, oh my god, how many wins, how better the win rate, and it's just because of one rule of the exponential moving average. And this applies to any strategy. Since trading only with a global trend, your win rate will always be higher. For example, in my last video, I created a trading bot using ChatGPT to see if it can trade in a plus. So applying this rule, the win rate increased by 9%. And by the way, if you want to know how I created that bot and what came out of that idea, click right here and watch this video. But that's going to be it for us for today. Thank you so much for watching. Don't forget to subscribe to this channel and like up this video, and I will see you in the next one. Bye bye.